Welcome back to Talk Tickers. It is Thursday, February 5th, 2026. And if you've been watching the pharma sector today, you know it's been a very specific kind of morning. We are fresh off the wires, breaking down the Q4 and full year 2025 earnings call for Bristol Myers Squibb.
And what a morning it has been. I mean, watching the tape, you could almost feel a collective sigh of relief from the market. BMY closed up, 3.3% at $59.52?
Yeah, and that wasn't on light volume either. We saw something like 23.9 million shares trade. The average is usually closer to 14, 15 million, so people were definitely paying attention.
Absolutely. And it feels like the whole sentiment has just shifted. For months, it's been doom and gloom.
Apocalyptic almost.
Right. And now it feels more constructive, maybe even, bullish leaning, which is not a phrase I've used for BMY in a long time.
It really feels like the narrative is changing. For 2 years, the story was fear, just fear of the patent cliff.
Yeah. The LOE, loss of exclusivity. But today, management, I think, really successfully framed 2025 not as a year of decline, but as a year of execution.
It's like they're shifting from fearing the cliff to actually executing the bridge to get over it.
That's the perfect way to put it, building the bridge.
So that's our mission for this deep dive. We'll hit the headline numbers, of course, but then we need to get into the weeds on the resilience of their growth portfolio and the very weird mechanics of the Eliquis IRA impact.
Oh, that Eliquis piece is fascinating. It's this regulatory quirk that is, it's basically saving their year, and almost nobody saw it playing out quite like this.
The math is just wild. We'll get there. We'll also look at the massive pipeline slate for late 2026, which is really the future of the company. And as always, we'll wrap up with our This Is Not Financial Advice segment with a trade idea that bets on all this clinical data.
Sounds good. Let's start with the scoreboard.
All right, let's do the numbers. Headline snapshot. Revenue for the quarter was $12.5 billion. Now, on paper, that's basically flat, up just 1% year over year.
Which doesn't sound exciting.
Not at all, but it did beat consensus, which was sitting around $12.28 billion. So yeah, a solid beat there.
And in this environment, where everyone was braced for a drop, flat is the new up.
Right, and it flowed down to the bottom line. Non-GAAP EPS came in at $1.26. The street was looking for something between $1.19 and $1.23. So a clear beat.
But the real story, the reason the stock actually popped today, was the guidance.
Exactly. The 2026 guidance. They're guiding revenue to $46.0 to $47.5 billion and EPS to $6.05 to 6.35 cents. Both of those are well above where the street was.
And that's key. But I want to peel back the onion on the quality of the Q4 beat itself. Because you know how it is. Sometimes a beat is just, a lower tax rate or some accounting trick.
Financial engineering.
Right. This wasn't that. This was legitimate portfolio rotation in action.
Okay, so let's unpack that term. What does portfolio rotation actually look like for a company this massive?
Think of it like this. You have the legacy portfolio, Revlimid, Pomalyst, the oldie drugs that are losing their patents. That whole bucket of drugs dropped by about $4 billion in revenue last year.
$4 billion. That is a massive hole to fill. Revlimid alone was down, 55% in the quarter?
A huge hole. And if that's all that happened, the stock would be in free fall. But the growth portfolio, that's Opdivo, Eliquis, Reblozyl, the new stuff, that grew 15 to 17%.
So it nearly completely offset that decline.
It nearly completely offset that massive legacy drop. And that's why the market is rewarding them. It's the Sado ratio. Management promised for years they could fill the Revlimid hole.
And a lot of people were skeptical.
Very skeptical. The thinking was, there's no way you can run fast enough to stay in the same place. But, mathematically, they're actually doing it. It validates the entire strategy.
So let's zoom in on those winners. You said Reblozyl seems to be the star.
Reblozyl is a monster, grew 21%. It's now annualizing at over $2 billion. It's for anemia in MDS patients, and the key driver is that it's becoming the standard of care in the first-line setting.
So it's the first drug doctors are reaching for now, not a last resort.
Exactly. And it doesn't matter if the patient is RS positive or RS negative. These are genetic markers that used to sort of limit the market. Now it's seeing broad adoption across the board.
And it wasn't just Reblozyl. Camzyos, the heart drug, grew 57%. Breyanzi, their cell therapy, up 47%. Even Opdivo.
Yeah, Opdivo grew 7% to $2.7 billion, which is impressive, right? It's still gaining share in first-line lung cancer, which is a super competitive space.
It really is. But, okay, we need to pivot. We have to talk about the most technical and, frankly, the most surprising part of the call. We have to talk about Eliquis.
Ah, yes. the Eliquis anomaly.
This is the blood thinner they share with Pfizer. Revenue is $3.45 billion, up 6%. But the guidance for 2026 is all tangled up with the Inflation Reduction Act, the IRA. And usually when you hear IRA in pharma, it's bad news.
It is usually bad news. It means price caps, revenue hits, and technically the price did get cut. So effective January 1st, 2026, the list price, the WAC for Eliquis, was reduced by about 40%.
Okay, 40% price cut. So if I'm a listener, I hear that, and I assume revenue is about to just collapse.
You would think so, right? If you sell something for $1 and now you have to sell it for 60 cents, you make less money. But management is guiding 2026 Eliquis growth to be plus 10 to 15%.
Wait, how? How does a 40% price cut lead to double-digit growth? That sounds like voodoo accounting.
It does, doesn't it? But it's all about the plumbing of the U.S. healthcare system. See, by taking that 40% cut on the list price, Bristol Myers no longer has to pay the inflationary penalties.
The CPI rebates.
Correct. For years, they've raised prices faster than inflation, and the government claws back a ton of money in rebates. Because the price of Eliquis was reset down, those penalties just vanish.
Okay, so they lose on the price, but they save a fortune on the fines.
It gets even better. It also basically eliminates their liability in the Medicare Part D catastrophic phase. So when you net it all out, the lower list price against the elimination of all these penalties and liabilities,
The net price they actually pocket is higher.
combined with volume growth, yes, it's actually a tailwind for 2026, a pretty big one.
That is just wild. A regulation designed to cut costs is actually boosting their P&L for 1 year.
For this specific year. And that's the crucial part. Management was very clear about this. This is a 1-year thing. They specifically guided for a step down in 2027 of about $1.5 to $2 billion for Eliquis.
And why does the music stop in 2027?
European patent expirations, they lose exclusivity in major EU markets in November of this year, which will hit full year 2027 numbers. It's the last hurrah in 26 before the international cliff in 27.
So the bridge is solid for 1 more year, but there's a drop-off on the other side.
Precisely. Which brings us to the other big launch everyone's watching, neuroscience. Cobenfy, the schizophrenia drug from the $14 billion Karuna acquisition. They need this to work.
Right. And revenue was just $51 million in Q4.
Which sounds tiny, I know.
It does. Was the market disappointed with that?
I don't think so. You have to look at the leading indicators. They've had over 100,000 prescriptions since launch. They say it's surpassing all the relevant schizophrenia launch analogs, so it's winning versus the competition.
And what about insurance coverage? That's always the big hurdle.
Access is really strong, nearly 100% for Medicare and Medicaid, approaching 70% on the commercial side. That's actually very fast for a new launch.
So the foundation is solid, but they kept talking about steady growth, not a huge inflection.
And that's just the reality of the market. This isn't oncology where you switch a dying patient immediately. In schizophrenia, if a patient is stable, even if they're not great, doctors are very hesitant to rock the boat.
So the growth comes from new patients, not from switching.
Exactly. It comes from new starts. It takes time. But they did note that once a doctor tries it, they tend to prescribe it again. So it's a slow burn, not a firework.
Okay, so let's reset. Growth portfolio is working. Eliquis holds the line for 1 more year. But the stock is trading on the future, and management kept calling 2026 a data-rich year.
And this is the why behind the bullishness. The 2026 financials are safe, that's the floor, but the ceiling, that depends entirely on the clinical data. They highlighted, I think, 10 plus phase 3 readouts this year.
10 phase 3 readouts. Wow. That's a lot of binary risk. What are the big ones to watch?
The biggest one, no question, is milvexian, their factor XI inhibitor. Data is coming in atrial fibrillation, or AFib, and in secondary stroke prevention.
So factor XI, remind us why that matters. We have Eliquis. Why do we need another blood thinner?
It's the holy grail of anticoagulation. The goal is to stop the clot without causing major bleeding. Eliquis is great, but it has a bleeding risk. Factor XI inhibitors theoretically can prevent strokes just as well, but with a much, much lower bleeding risk.
That would be a game changer. But isn't Bayer's competing drug, asundexian, didn't that one fail?
It did. It failed for lack of efficacy, which cast this huge shadow over the whole drug class.
So why is Bristol so confident?
The debate is all about the dose. Bristol believes Bayer underdosed their drug. Bristol is using a much higher twice-a-day dose. They're basically betting that Bayer just missed the target.
But they don't know for sure yet. It's still blinded.
It's still blinded. But the fact that the independent data monitoring committee keeps letting the trial run is, it's often a good sign. No news is good news in these things.
Okay, so milvexian is the huge swing. What else?
There's Admilparant. It's for pulmonary fibrosis.
Scarring of the lungs. A really terrible disease.
Awful. And the current treatments have horrible side effects. This drug showed great efficacy in phase 2, but there was a safety worry. Patients were fainting.
Not great.
No, not great. But management seems confident that the dose they're using in phase 3 is holding up safely in the blinded reviews. If this has a clean safety profile, it could completely replace the current standard of care.
And then quickly, the cell mods in oncology.
Iberdomide and mezigdomide. These are the oral successors to Revlimid. They're designed for the community setting, for the local oncologists who can't use complex CAR T cell therapies. They're off-the-shelf pills.
So a diverse set of shots on goal for later this year.
Exactly. This is the year we find out if the R&D engine is really working.
And before we get to the trade idea, just a quick touch on capital allocation. They're tightening the belt, right?
They are. $1 billion in savings in 2025, another $1 billion targeted for 26 and 27. They're trying to get lean.
But margins are compressing a bit.
Yeah, gross margin guidance is 69 to 70%. But that's just product mix. It's more lower margin Eliquis and less high margin Revlimid. It's not operational weakness, it's just math.
And M&A. Are they on the hunt?
They said they're not chasing deals, just smaller bolt-ons they have enough to execute on right now.
Okay, let's get to the fun part. We've looked at the numbers, we've looked at the pipeline. Now let's talk about the trade.
All right, let's hear it.
Welcome to our This Is Not Financial Advice segment. And as always, please remember, we're just talking here. This is for entertainment and educational purposes only. Do your own diligence.
Please do.
Okay, so here's the pitch. I call this the volatility catalyst straddle.
Okay, sounds expensive.
Here's the setup. Right now, BMY is trading like a safe, boring value stock. It's up today because the floor didn't fall out. It pays a nice dividend. It's a bond proxy.
Right, it's the stock you buy your grandma.
Exactly.
Yeah.
But that view completely ignores the second half of this year. The market is pricing BMY based on financial execution, which is slow and steady. I think it is completely mispricing the data-rich event path.
You're saying the implied volatility in the options market is too low.
Way too low. I mean, think about it. You've got milvexian and Admilparant reading out. These are binary events.
Yeah.
If milvexian hits on safety and efficacy, BMY is not a value stock anymore. It re-rates overnight as a growth biopharma. The stock could jump 20, 30%.
And if it fails, if the factor XI hypothesis is dead.
If it fails, the whole bridge to 2030 narrative just collapses. The stock revisits the lows, it drops hard.
So it's going to move big one way or the other.
Exactly. So the trade is this.
Yeah.
You go long the stock itself for the yield and low valuation. That's your anchor. But then you layer on top of that long straddles or call spreads dated for Q4 2026.
So you're buying a call and a put. You don't care which way it goes. You're just betting that it goes. You're buying the variance.
I'm buying the variance. I have no idea if the drug works, but I know the reaction to the data will be massive.
Yeah.
The market is treating this like a slow-moving ocean liner, but come November, it's a speedboat. Either it hits the rocks or it wins the race. We should stop treating it like a bond proxy and start trading the pipeline variance.
That is actually a very compelling thesis. You're betting that the market is just too complacent about the actual science that's about to be revealed.
Find the mispricing. Exploit it.
So to recap then, Q4 was a solid execution beat. They did what they said they were going to do.
The growth portfolio has finally officially crossed the line to outweigh the legacy decline. That's a huge psychological turning point.
And as 2026 looks safe on earnings thanks to that weird Eliquis math, but it's going to be incredibly volatile on the clinical data.
The bridge is built. Now we just have to see what's waiting on the other side.
The better than feared rally today is definitely justified, but the long-term story, that depends entirely on what happens in the clinic over the next 10 months.
And we will be here to cover it when that data drops. That's it for this deep dive into Bristol Myers Squibb. Thanks for listening to Talk Tickers.
We'll catch you on the next print.